Welcome back, everyone. Monthly dividend-paying stocks are some of the most appealing dividend investments because, as the label suggests, they pay investors dividends each and every month. What's not to love about receiving a high and consistent stream of dividends flowing into your pocket every month? The appeal for monthly dividend payments has grown rapidly in the last few years. Today, there are at least 60 different stocks and funds that promise investors a monthly dividend stream, and the new offerings promise ever higher dividend yields. Personally, I'm more of an old-school investor that appreciates a respectable dividend yield, but what I also want to see is the promise of long-term capital appreciation. Today I want to tell you about my 3 favorite real estate investment trusts that pay handsome dividend yields, but also have long-term total returns that are better than the S&P 500. We will take a closer look at each of these REITs, talk about the potential dividend income they can generate for you, and most importantly, I'll tell you how you can tell when they are attractively valued using my simple valuation tool specifically designed for REITs. Let's get right into it. I'm going to kick things off with Agree Realty Corporation, ticker symbol ADC. The company currently has a market cap of $5.88 billion and sports a forward dividend yield of 5.06%. Year to date, the share price is down nearly 18%, but since its inception, Agree Realty has grown by more than 200%. It has a long-term compound annual growth rate of 11.5% since 1994, compared to 9.82% for the S&P 500. So not only has this REIT crushed the S&P, it has paid handsome dividends while doing so. The company has a portfolio of over 2,000 properties, primarily focused on the retail sector, but it is pretty well diversified amongst several segments such as grocery, home improvement, and dollar stores, to name a few. Its largest tenants are well-known companies like Walmart, Tractor Supply, and Dollar General. The company has been actively investing in new properties, acquiring more than $8.5 billion in high-quality net lease properties since 2010. They have paid 140 consecutive dividends and boast a respectable 6% 10-year CAGR through 2022. I personally have a position in Agree Realty, and I continue adding to this position when the valuation makes sense. Another favorite REIT of mine is the one and only Realty Income, ticker symbol O. Realty Income is much bigger than Agree Realty, with a market cap of $35.86 billion, and it currently sports a slightly more attractive dividend yield of 6.09%. Year to date, its share price is down a little more than 20%, but since its inception, it has grown by a whopping 538%. Realty Income has a long-term compound annual growth rate of 13.01% since its IPO in late 1994, compared to a 9.77% rate of return for the S&P 500. Much like Agree Realty, Realty Income has crushed the S&P 500 and paid a growing dividend stream while doing so. You can view Realty Income as Agree Realty's big brother, as it boasts a portfolio of over 13,000 properties, also focusing primarily on the retail segment. The company has been growing its international portfolio during the last few years, making them the 7th largest REIT globally. They have a 29-year streak of consecutive dividend growth, paying out 640 monthly dividends with a record of 104 consecutive quarterly increases. This impressive dividend history earns them a spot amongst the best dividend growth stocks on the coveted Dividend Aristocrat list. Most recently, the major headline for the company has been its deal to acquire Spirit Realty. This acquisition is expected to make Realty Income the 4th largest REIT and the 150th largest company in the S&P. Management expects the transaction to positively increase AFFO per share and generate favorable cost synergies. The 2 REITs have complementary portfolios, sharing 14 of their top 20 clients, which will deepen existing relationships while offering added diversification. And best of all, Realty Income will not have to raise new capital to fund this transaction. I've personally held shares of the stock for many years, and I continue to add to my position when the valuation makes sense. The 3rd REIT I'd like to talk about today is Stag Industrial, ticker symbol STAG. The company has a market cap of $6.3 billion and pays a 4.27% forward dividend yield, the lowest of these 3 REITs. Year to date, it has performed the best, as the share price is up nearly 6%, and an even more impressive 191% since its IPO in 2011. Stag has the shortest track record of the 3, but still a very respectable one. Their long-term compound annual growth rate has been 14.2% since mid-2011, compared to an 11.41% rate of return for the S&P 500. Just like the prior 2 REITs, Stag Industrial has outpaced the S&P 500 and made handsome dividend payments to its shareholders in the meantime. Stag boasts a portfolio of 558 properties, spanning 41 U.S. states, with a focus on industrial real estate. They have a very well-diversified portfolio of tenants, with the top 20 making up less than 20% of annualized base rent. Its largest tenant is Amazon, making up 2.8% of the portfolio, with no other tenant representing more than 1% of ABR. STAG has grown its dividend since inception, but lately that dividend growth rate has cooled off, with the last 4 years seeing growth below 1%. While that may not look overly appealing, what this REIT lacks in the dividend growth department, they have more than made up for with long-term capital appreciation. I have personally owned STAG for many years now, and I continue adding to my position when the valuation makes sense. If you adopt a long-term investing strategy using a combination of these 3 REITs, you can expect to receive a 5% dividend yield, with an additional 5 to 6% in capital appreciation. This will give you the best of both worlds, some good and consistent passive income, while also seeing your capital appreciate over time. For me, that's quite an impressive combination for a monthly dividend-paying portfolio. Investing equally into these 3 REITs today would give you a dividend yield of slightly more than 5%. With this dividend yield, it would still require a substantial investment to create a meaningful dividend income stream. A $10,000 investment would generate approximately $500 in annual dividends. That's not going to be life-changing, but you have to keep in mind that investing is a long-term endeavor, and if you're patient enough to do it consistently for many years, the results can be very rewarding. Consider this. If you can save $100 a week for 10 years, if you simply hold these savings as cash, after 10 years you'd have saved $52,000. That's a good chunk of money. A better option today would be to save this money in a high-yield savings account, opposed to holding it as cash. A typical high-yield savings account can earn an annual yield of about 4.5%. If we assume that this interest rate would remain unchanged for the next 10 years, and you reinvested all of the interest along the way, with a savings rate of $100 per week, after 10 years, your high-yield savings balance would be a little more than $66,000. That's an additional $15,000 over holding cash, with virtually no added risk. Now, I personally don't think that high-yield savings accounts will continue to pay attractive interest rates consistently for the next 10 years. These rates are highly based on the federal funds rate, and the consensus opinion is that at some point in 2024, the Fed is expected to start cutting the federal funds rate. If this happens, we will start to see the interest rate on high-yield savings accounts move lower. Now, an even better option, but one that carries a little more risk, would be to invest in the 3 REITs I just mentioned. Over the next 10 years, we could assume that these REITs could deliver a dividend yield of a little more than 5%, with about 5 to 6% in added capital appreciation. To keep the math simple, let's just say the total rate of return would be 11%. Now, we won't see a steady and consistent return of 11% each year, but over the course of a decade, it's not unreasonable to assume that we can see an average rate of return of 11%. Assuming we can, the same $100 per week savings rate would grow to a little more than $95,000, which is about $44,000 more than simply holding on to cash, and about $30,000 more compared to the high-yield savings account. To me, the risk and reward trade-off is worth the gamble because having $30,000 or $40,000 more is a meaningful amount. After 10 years, this $95,000 portfolio would pay roughly $5,000 per year in dividend income, or a little more than $400 per month. Essentially, it would take about 10 years for this portfolio to start paying you back your weekly contribution in the form of a monthly dividend payment. That sounds like a pretty good deal to me. We all know that stock prices go up and down on a daily basis, and it's difficult to figure out when stocks are attractive or not. The best way to value a real estate investment trust is by looking at its adjusted funds from operations, or AFFO. Much like you use the price-to-earnings ratio to value regular stocks, for a real estate investment trust, it is more useful to look at the price-to-AFFO ratio. These ratios are not as mainstream on financial websites, so they require a little bit more effort to find. To simplify my life, I recently built my own valuation tool specifically for REITs that uses the price-to-AFFO ratio to tell me whether or not a given REIT appears attractively valued today. I want to show you how this works, so let's take a look at the current valuation for the 3 REITs I talked about today. I'll start with Agree Realty Corporation. The stock currently trades for a price of about $57, and based on its historical price-to-AFFO ratio, it should be fairly valued closer to $76, which implies that it is in fact attractively valued today. My tool basically looks at the rolling 5-year average price-to-AFFO ratio the stock traded for, and compares the current price-to-AFFO ratio to that trailing 5-year average. From the data, we can see that in 2018 and 2019, Agree Realty traded for a premium price-to-AFFO ratio that climbed from about 18 to somewhere in the range of 25. Prior to 2018, the stock traded for a much lower multiple of its AFFO per share, implying that a fair multiple was somewhere in the range of 16 to 17. This period of premium valuation caused the 5-year trailing price-to-AFFO ratio to increase, from that original range of around 16 up to around 20 today. Since early 2020, we have seen Agree's share price move mostly sideways and start to dip over the last 12 months or so. While the price stagnated and even declined, the AFFO per share continued climbing. implying that while the share price remained rather unchanged, it actually became cheaper from a valuation perspective. Today, Agree Realty trades for a price to AFFO multiple of about 15, which is about 25% below its trailing average multiple of about 20. Even if we consider the trailing average price to AFFO ratio to be somewhat elevated because of that premium valuation in 2018 and 2019 that is still included in the 5-year average, the discount this tool is showing is significant enough to give us a little cushion, or margin of error if you prefer to label it as such. It is also worthy to note that I was not able to find the 2023 AFFO per share value, and opted to use the 2022 figure for the current year. Once we do know the final 2023 AFFO per share value, and if it is higher than the 2022 value, that will only increase the current fair value and give us a larger current undervaluation. Let's take a quick look at Realty Income now. The stock trades for about $50 per share, and my tool implies that it should be fairly valued at about $71, giving us an almost 30% undervaluation. If we take a quick look at the trailing 5-year average price to AFFO ratio, it has remained rather consistent in the range of a 17 or 18 multiple. This suggests to me that the valuation is a little more reliable, barring any changes to the underlying business, of course. The historical price chart shows us that pretty much since the 2020 pandemic crash, Realty Income has been either attractively valued or fairly valued, and the price decline in 2023 is giving us another pandemic crash buying opportunity. Okay, let's take a quick look at Stag Industrial as well. The stock trades for a little more than $34 today, and my tool gives us a fair value of a little more than $36. At first glance, Stag appears to be reasonably valued and maybe trading slightly below its fair value, but definitely not as attractive as Agree Realty or Realty Income. Its long-term trailing 5-year average price to AFFO ratio has been pretty steady as well, right around a multiple of 16. From the historical price chart, we can see that the stock soared in 2021, pushing the share price to a premium valuation of about 23 times AFFO per share, right around year-end. Then in 2022, it came back down to earth and kept declining to a low multiple of about 12 times AFFO per share. It's recovered a little bit here in 2023, but still looks reasonably valued right now. I also wasn't able to find the 2023 AFFO per share value. Once that figure is available, this valuation will shift a little, depending on where the company finishes the year. This valuation method isn't meant to be a one-and-done measure of whether or not you should buy any of these REITs, but it is a very handy tool to have if you like investing in REITs. If you'd like to get this tool, you can consider joining my Patreon. This tool and a few others are available there, along with personal access to message me directly with any questions you may have. The tool is pretty automated. The only part that is necessary from you is to populate the annual AFFO per share data between 2013 and today. I added a few other popular REITs into the tool already to get everyone started. You can find the AFFO per share values on Seeking Alpha in the Financials section near the bottom of the income statement. You can also go directly to the source and use the financial reports companies share publicly on their websites. Here's an example from Realty Income, straight from their investor relations webpage. If you're already a Patreon member, you can download this valuation tool right now. There is a brief how-to section in the spreadsheet to get you started. It's really easy to use. I hope you enjoyed the content. If you did, please give this video a like and subscribe to the channel. Thank you for joining me today, and see you next time.